Welcome to the latest edition of our Fixed Interest podcast series. I'm Thomas Rookmaaker, head of Asia Pacific Sovereign Ratings, and today I'm joined by Krisjanis Krustins, a director in Fitch's Sovereign team and lead analyst for Japan. We will be discussing some of the questions that we have received recently from investors about Japan, and in particular following the rise in bond yields. Questions like how far could yields go? How do we see the outlook for fiscal policy? And what does this all mean for Japan's sovereign rating? Now, Krisjanis, let's start with the yields. The 10-year yield recently surged close to 1.6%, and there have also been spikes in the ultra-long bond yields not too long ago. So what's going on, and what does this mean for Japan's debt sustainability?
There's a couple of things going on. We have persistent inflation, which is becoming entrenched around the Bank of Japan's 2% target level. In fact, some people are beginning to believe that it is becoming entrenched at a higher level. We have the Bank of Japan gradually tightening policy, stepping back from the JGB market, and we have more recently market concerns about fiscal policy in Japan. The yield moves that we have seen so far are still within our and the government's assumptions. So we, in our baseline debt dynamics, assume that the 10-year JGB rises to 2% by the end of this year. This is in line with the budgeting assumption. And any movements in yields do impact the budget quite gradually. It takes a while for any changes in yields to be reflected in the cash outlay for interest spending. And we cover this in more detail in a special report that we recently published on Japan's debt sustainability in a rising yield environment. You would have to have very aggressive changes in yields to make any big difference in the next few years. More broadly, the near-term fiscal outlook for Japan is actually quite good. We have overall fiscal deficits, which are below pre-pandemic levels, quite in contrast to many other developed markets. And the debt to GDP ratio is falling and is unlikely to hit those pandemic levels, even in quite pessimistic scenarios, anytime soon. But there are increasing concerns about fiscal policy, particularly in the run-up to the upper house election. And I think that's what is really driving the more recent increases in bond yields. When it comes to the ultra-long yield segment in the 30 to 40-year range, we think that's more related to fairly specific factors around Japan's life insurance industry and is not really reflective of broader fiscal concerns.
So how far could yields go? When would you get worried?
Well, as a ratings agency, we are not in the business of making market predictions, and there wouldn't be a single number where we would begin to panic. So our baseline assumption is 2% by fiscal year end 2025. This is manageable and in line with Ministry of Finance assumptions. We have played around with various shock scenarios, for example, a 100 basis point shock to the 10-year yield, and this is quite aggressive, say if we look at real yield differentials with other developed markets or Bank of Japan estimates for the neutral policy rate. And in isolation, even if we have the 10-year rising by another 100 basis points beyond our 2% assumption, the debt dynamics impact is manageable, although it does accelerate in later years.
Could you talk a bit more about these election-related fiscal concerns? How serious are they?
Yes, so essentially there are a lot of potentially very costly policy proposals that have been put forward by the various political parties. These include cash handouts and consumption tax cuts of varying sizes. We are talking about a fiscal deficit impact of potentially several percentage points of GDP under some of the more aggressive options. And the markets have been very concerned that any Japanese government following the upper house elections, whether or not it continues under LDP leadership, would have to lean into this discussion about looser fiscal policy and that this could undermine debt sustainability. We have been getting quite a lot of questions about whether we will be downgrading Japan's ratings in the wake of the election. While we do see the risk of looser fiscal policy as real, we are currently taking a more balanced view of all these discussions. Well, first of all, this is because we already have quite conservative fiscal forecasts. So we are forecasting much wider fiscal deficits than Japan's cabinet office. We are assuming ongoing supplementary budgets larger than those that we have seen historically. We're taking into account increases in various spending items as being legislated. We are taking into account some moderation in revenue growth. So to some extent, we're capturing this risk of looser fiscal policy. The second point is that, as mentioned earlier, the starting point is quite good. Low fiscal deficits and a baseline of debt to GDP falling. So there is a bit of room within these forecasts to accommodate a fiscal policy shock. And finally, it is worth noting that in Japan, the final policy outcomes can be quite different from what the initial headlines suggest. So as an example, we can think back to earlier this year when there were discussions about increasing the non-taxable income threshold as was demanded by the Democratic Party of the People. While this did happen and was finally legislated, the estimated impact is turning out to be much smaller than initially feared, partly because this was done in a progressive way. So there are a lot of policy levers that could be pulled, and there will be a lot of aspects to these discussions. So we would want to see how this plays out.
So what's behind this surge in fiscal populism in Japan? That's quite an interesting development. On the face of it, Japanese economy is doing quite well. We forecast relatively decent growth for Japan at 0.9%. Unemployment is low, wages are finally rising, and stock markets have been doing well.
So as in many other places, inflation is still the essential concern. It's difficult to overstate how unpopular it has been with the Japanese public. Households still seem to feel left behind, and while wages are rising, they haven't really compensated for the loss of purchasing power in recent years. The weak yen is also a particular issue. The Japanese just feel much poorer relative to the rest of the world, and that also relates to sort of fairly accommodative monetary policy. So while inflation has been very good for the public finances, governments have felt pressure to give back some of these benefits with handouts, subsidies, and tax cuts. We've already seen that play out, and it is playing out more strongly now in the run-up to the elections. It's possible that the solid public finance performance and this good starting point is also what has emboldened some politicians to propose looser fiscal policies.
So what would have to happen for Fitch to downgrade Japan?
So at the time of any rating action, we highlight the factors that could move the rating or outlook up and down. And the foremost sensitivity for Japan, both on the upside and the downside, is the medium-term trajectory of government debt. On the downside, as a factor that could potentially cause a negative rating action, we mention expectations of a persistent, significant rise in government debt to GDP over the medium term. So it's always a combination of factors that we look at, not just yields or deficits or fiscal policies. So we have to look at the totality of what drives the debt dynamics. That said, a fiscal policy is a key risk and a factor that we are closely watching.
Looking over the longer horizon, how do you think about the risks for Japan's public finances and debt, in particular from aging?
So this is something we also looked at in our recent report. And there are a couple of factors that will put pressure on the deficit. So in the next few years, you have higher childcare and defense spending, as has been legislated and as we're taking into account. We have higher interest rates getting priced in or reflected in the government's debt stock and showing up in the cash outlay for interest. And then we have the more long-term issues of persistent pressure on public health spending from aging. Now, the government estimates that this could be around 0.04% per year in the longer term, but this could easily be higher, given that, for example, the government's own demographic projections have proven to be a bit too optimistic in recent years. So these are the sort of pressures that we are baking in to our debt dynamics, and we still do not see debt to GDP turning convincingly upward before the 2030s. And it's also important to note that there is scope for policies to adjust. So the authorities have been discussing and analyzing measures on health, for example, to means test benefits and adjust contributions, taking into account financial income and assets in the structure of these benefits. There are some policy options, and there have been fiscal reforms in Japan in the past, both on social security and other aspects of public finances. So none of these issues are intractable.
Thanks for your insights, Krisjanis, and thank you all for listening. For more information on our ratings and on our research on Japan, please visit us at fitchratings.com. We hope you will join us for the next edition of Fixed Interests.